Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audiocast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
Long-term returns, say a gain of 20%, particularly in the equity markets, are invariably determined by beta. As such, your investment returns are invariably correlated and held hostage by the long-term trajectory of the equity market itself, a far from ideal situation by any logical stretch of the imagination if you and your clients are trying to generate consistent monthly, indeed quarterly performance returns. Tuesday, September 21st, 2010, and this is Conversations, the official MTA podcast series, Season 2. And all this month, we're featuring an all-Britain slate of guests to celebrate the opening of the new MTA office in London. Today's guest from Mint Securities in London is Geoff Wilkinson. Geoff Wilkinson has been head of investment research at Mint Equities, a leading trading house, for the last 6 years, where he coordinates the research output and advises hedge funds on trading strategies. Geoff brings direct investment expertise to this role, gained specifically from senior hands-on proprietary trading roles, primarily within the hedge fund environment. Throughout his investment career, he has been an avid proponent of technical and quantitative analysis in both formulating investment decisions and as an essential component of risk management. He is a regular contributor to CNBC and Thomson Reuters. He lives in Chelsea, London, with his wife and 2 children. His main interest outside family and work is fishing. Geoff Wilkinson, welcome to the program.
Good afternoon. Very glad to be here. Thank you.
Good afternoon to you. We're very flattered that a television star from CNBC would make time to join us today.
Well, that's very kind, but I think I've probably got a face for radio. I'll have to push on from that.
Geoff, we like to start with a little personal history on our guest. Why don't you give us a minute or two on where you grew up, where you went to school, to university, what you majored in, and how you made the transition to technical analysis?
Well, I grew up mainly in the UK with the odd stint overseas. My father was an officer. He's retired now in the Royal Air Force.
Oh.
So I moved around quite a bit when I grew up. But I eventually I went to a public school just outside London in Oxfordshire. I was there for 6 years, and that's pretty much where I completed my secondary education. Following that, I went to Durham University. And I graduated with a BSc in geography.
Geography.
So not a particularly financially auspicious start from that perspective.
Yeah. Well, how did you make the jump?
I mean, in terms of coming out of university, I joined Standard Chartered International Bank as part of their graduate trainee program, and worked for another 7 years overseas in their international banking division, both in Hong Kong, and that was followed by a lengthy stint in the Middle East. So that brought me into contact initially with things like foreign exchange, interest rate risk management, and I suppose very shortly after that, if you ever, as you know, in currencies, it's a very technical market. If you really want to understand them, then technical analysis is actually a very essential tool set. Mm-hmm. So that's how I actually got into finance. And curiously, obviously, I don't know whether my degree, having spent many years looking at maps, I think probably charts probably qualify as something in that category as well.
Ah, I see. Right, charting the markets.
Pattern analysis.
So then, okay, that's good. Then bring us up to present date. Explain to us what it is you do on a daily basis at Mint Equities.
Well, I do a couple of things here. Primarily, I advise hedge funds and institutional fund managers, primarily about tactical timing. You know, most of my clients have a pretty good idea about the value of something. They're just probably a little bit undergunned sometimes on, timing. Valuation methodology, particularly in equities, as you know, is still the dominant means of analyzing stocks. Obviously, technical analysis is making great gains in that area, and the equity market, I think, is more technical than many people think. But my prime job is really to try and make sure that from a risk management perspective, they're getting in and out of trades at the right level on a tactical horizon. And I perform a similar function for the traders here in terms of providing them with both research ideas and answering their client inquiries regarding specific stock selections or sector selections.
Okay. All right. Well, we want to get into some of the tools you use, and perhaps this is an interesting time to be making some prognostications on the market, given we're not only at some important technical levels, but for those that are interested, we're at the autumn equinox. However, before we get to that point, there is a question that I wanted to touch on before we got into too much detail, which I think might be fun for all our listeners. And I'll ask it this way. I keep a blog at my website, seattletechnicaladvisors.com, and every day I try and post a new video of a technician giving his or her opinions on the market. And what I've found, if I go to most websites, including CNBC here in America or in Asia, it's very difficult to find a video focusing on technical analysis. But CNBC Europe features an interview almost every day with a technician. Is there a hunger for technical analysis in Europe or Europe and England in particular? Is there something going on differently there than there is here in the States? So can you give us some insight? Do you know anything about this?
Yeah, I don't know. I mean, CNBC actually does have technical slots twice a day during the week, and Reuters has seems to have enormous demand for it as well. I don't really know. I mean, it's historically, obviously, London has been the centre of the foreign exchange market. That's always been very technically driven. But again, in Chicago, you have the big futures markets there, and there's nothing more technical than the futures market. So I don't know. I mean, I suppose for more, I don't know whether it's catering to the professional investor base or the retail investor base. But I mean, one thing's for certain. I mean, I think that the US must reflect demand. But I can't imagine that, given the markets we've seen over the last 9 months, that technical analysis is undersubscribed. I mean, I think it's been exceptionally useful in these particular choppy markets over the last 6 months. So maybe there's an opportunity there for some technical analysts based in the States to stand up and be counted.
There you go. There you go. All right. Let's move on to a portion of our podcast we call a toolbox, where we try and look at just what kind of tools or what particular tools a technician's using. Let's talk about the tools you use for your analysis. Can you share a little of that with us?
Yeah. We have a sort of a divided approach. We use quantitative tools to screen the stocks and in fact even at the indice level for broad market trends. So we use a quantitative process to tell us to which degree markets are trending, and how much each stocks, and we rank them on a scale from plus 10 to minus 10, minus 10 being very, very negative. So from that perspective, I think it's a good baseline. My own research tends to concentrate almost specifically on chart analysis. I've been a chartist for pretty much all my career. I don't use an awful lot of statistical studies in that. I think the detail is in the price action. And I tend to stay away from anything that's too historical, like moving averages, because they can perfectly describe where you're coming from, but I think they're particularly poor at saying where you're going. I think both directional momentum is very important. You can analyze that quantitatively, but you can also see it on the slope of the trends in the market. And then I supplement that with an awful lot of pattern analysis, and that goes right the way down, to individual bar charts, a whole range of candlestick patterns, and all the classic reversal patterns that you want to see. But I'm particularly interested, more than anything, in the changes in the daily price action on the bar charts, and and how that evolves from day to day. I think that's where the real information is for me in the market.
Well, I wanted to ask you about that. I know that stops are an integral part of your trading strategy, and yet you've written that the majority of your technical analysis is based on trend lines constructed on daily closing prices. So are your stops based on closes, or do you allow yourself to get stopped out intraday? I
think that's a horses for courses. I mean, the the validity, I mean, closing prices are, you know, if you draw lines, my general experience over the years is they're far more meaningful than intraday support resistance levels drawn on the same basis. The daily closing prices is where people's P&L crystallize. It's as simple as that. They're very memorable. People always remember the levels. And generally, when you're looking at retracements to trend lines or sell-offs from, you know, resistance levels in the market, it's generally much more reliable, in my opinion, to stick with the daily prices, which also have tremendous memory on an intraday basis as well. So once the trend line's constructed on a daily closing price basis, it will work on an intraday basis as well. Again, though, in some situations, I mean, you do have to pay attention to where the intraday support and resistance levels are because, you know, that just comes down to basic risk management. And at the end of the day, that's the essential part of the process. So,
well, it just seems like in such volatile markets that you could be right on the closing price and yet get stopped out during the day.
I think, you know, that's to some extent that depends on, you know, that decision is made on experience. But if you look at, again, it varies by particular market. For example, in Europe, we trade both the Stocks 50 future extensively and the Stocks 50 cash. Now, they're obviously exceptionally closely related, but trading the Stocks 50 future on a daily closing basis is virtually meaningless. You have to look specifically at the intraday levels on that one because it trades, you know, very extensively off those. In the cash market, though, whilst you do have some influence from the futures market as well, the cash is particularly reliable in terms of where the daily closing prices are. So if you're constructing your main trend lines in that index, support and resistance levels, it's going to work well in the cash, but it's virtually meaningless in the future. You will get stops out on the daily closes in that market on a regular basis. So there we are. And there we are.
We're going to continue with Geoff Wilkinson in a moment, but first a reminder that on next week's program from City Index in London, we'll have as our guest Sandy Jadeja. I hope I pronounced Sandy's name correctly. Geoff, let's talk fishing. I suspect that fishermen are pretty much the same everywhere. When I was a boy, my father, who was an avid fisherman, took me to a fishing exposition where a local minor celebrity was appearing. This man had his own weekly television show on the local network affiliate about fishing. And when asked what advice he'd give a young boy, he replied, "If you want to catch fish, you have to keep your line in the water." Well, you know, for several years, I thought that comment applied only to fishing. But as I grew older, I began to understand its broader significance. It applied to more than just fishing, but life in general. Now, you're a fisherman. Has fishing taught you any lessons that can be applied to the markets in general or technical analysis in particular?
I think the, one of the things, you know, I've been fishing ever since I'm very young as well, and I do agree with the original comment that you know, you do need to have your line in the water to catch fish. And I've done over the years, I've done quite a bit of sort of competitive fishing, and that's absolutely true there. The people who tend to catch the most fish are invariably the ones that spend most of their time fishing. As opposed to not fishing. So I think that, you know, that's absolutely true. One of the things that has always struck me about fishing is you know, when you turn up to fish any particular stretch of water, I mean, you do have an awful lot of different variables there. I mean, the weather changes every day, the pressure changes every day, the water speed, the wind speed, the depth changes, and the fish change, and then fish move around in very, you know, I wouldn't say random, but they, you know, every day is different. And in my experience, that's to some extent, you know, if you want to be quite successful at that, you sort of got to have that kind of approach when you're looking at the markets. Everything is different every day. You know, patterns repeat themselves, or, you know, but not quite in the same way. And, you know, and again, you know, there are, you know, factors influencing in the market every single day. So you really are sort of a multiple sort of multivariable analysis of both. And I think, again, you know, it's the attention to the detail in both cases. You know, you need to have, you know, a good grasp of all the variables. And then you finally eliminate all the ones that aren't working, and you end up with one or two really good opportunities potentially and hopefully, and the same in fishing, one or two good fish. So I think actually from a mindset perspective, the idea that you could potentially, it can be very difficult at times, as you know, and certainly the market is as well. So from that perspective, and I think there's a lot in common with going fishing. Although, in fairness, I think, most of the time fishing is a lot more fun. So.
Okay. All right. I want to get back to our toolbox, so to speak, but I always reserve at least one question for our guests, which is of particular interest to me, regardless of whether anybody else wants to hear it or not. And so here's today's question from Ed. You use, as I do, the 76.4% Fibonacci retracement level. You call it the last chance saloon. But what I've noticed is a lot of technicians talk about the 78.6% level. How did you come to use 76.4 versus the 78.6?
I think that's the one that I've always that comes up on any time I've ever constructed on a system. So
okay.
I just let me just can I just have a quick look at the chart here? Actually, I just want to let's have a look at that. Yeah. So for me, it is the 76.4, and for me over the years, that's the one that seems to have delivered most of the goods, not just in terms of stopping the market. But in terms of confirming that we are going to recover the entire rally. So it's one of the ones, maybe because my background was in currencies and I've seen it work there a number of times, that I just tend to stick with it here today. So I guess old habits are hard to break.
Okay, well, fair enough. You called the back in 2006, 2007. You were making noises that you saw a major decline coming starting in 2007. Yes. Why don't you share with us a couple things? Number one, what made you conclude that? And number two, is this an ongoing decline? Have we finished up with it? Is it over?
Well, the first thing actually, I don't know if anybody's got a stock chart. I mean, one of the things, which I was very interested in at that particular time is that, obviously, we were in this can only go up. Every company was being taken over and everything was going up. So we're in a classic sort of, I would say, bubble type environment. But then, and again, we saw this in May this year before the big decline there. You go from just looking at the price action, you go from quite steady sort of, appreciation. Every day is buying it. And what I thought was quite interesting there was that you just saw an increase in volatility, but no further upside progress. And that was very similar to what took place in May this year before the May decline. So this is sort of like a fractal analysis. And, and I do use fractal, that everything works at, the same things work at different time scales. So from a fundamental perspective, it was very, anybody who traded at the time, it was going to go on forever. There were some guys out there putting out some very, very bearish comments, and some people made a lot of money on it. But for me, it's one of those things, if the trend's established, and maybe we're in a situation now where, although I think we could still be in a counter trend, that you've really, the trend is your friend until you either see some evidence of exhaustion creeping in or some evidence of a reversal that you feel comfortable about. The old adage is true. You just have to stick with it. But at the time, I think there was sufficient volatility. There was a change in the volatility characteristics of the market. You probably wouldn't have picked it up on a moving average system, but you could certainly see it in the daily price action. And I think subsequently from that, once we started to come down, then we had a very long market and we started to come down very quickly. And then we got into the classic situation where you've got investors long above the market, exactly what happened in, for example, BP, when you've got a sudden, immediate move down, investors get trapped above the market. It creates an overhang of selling interest. And from that perspective, it's one of those situations that if you've seen it before, and we saw it with Nokia earlier in the year, that you remember, and that was it really. So from that perspective, I do think that the current situation, I'm not quite sure whether we're going to turn down from current levels, but I've got a real suspicion that we're getting up to levels from this perspective. We're either going to make a very big decision to head lower, or we're going to push up a bit further and go very, very, at least back to say, the 1200 level highs in the S&P 500. So it's very, very polarized right here, right now in the market. I don't rule out seeing new lows in the equity market from here. I don't think we've quite done enough yet to suggest that the recovery that we've seen in July this year is anything other than counter trend at this moment. But it's a very tough call here.
Very tough call. We're at an inflection point.
We are an inflection point. I mean, tactically, the case for buying it has been well made. One thing which I would say from a price action perspective over the last few weeks is that this looks very much like a covering driven rally. The price action is, just
straight up.
Yeah, exactly. Nobody gets a chance to get back in. The initial move was very, very sharp when we look back to the end of August, and I think it took a lot of people by surprise. What I think is quite interesting as we're getting up to these levels is the real debate as to whether these. Okay, we've definitely corrected the tactical short positions in the market. The question going here, and you particularly see that if you look at the European banking indices and some of the US ones as well, it's like there's one thing getting back to square, but haven't anybody made a decision to go long here at the equity market? And I think those are the levels we're getting up to. It's all very well to go back to where we started and to the back of the current ranges, but at the end of the day, that may be just a correction of a structural short in equities, because equities have had such a torrid time. Look how well the bond market's doing. Is some money coming back into the equity market on the basis of rebalancing at the portfolio level? But then it's another decision after that for investors to say, well, actually, do you know what? We do like the equity market and we really want to go long. And I think that, that might drag out for a month or two, but that's, if you're looking at in simplest terms, coming back to your point about is this a point of inflection, I think that's where we are in the point of inflection. We're getting back to square, but are we going to make the decision to really buy the equity market going forward from here? And that's a tough one, considering how badly you've really fared doing that over the last 12 months or so.
Right. I like the way you put that. Geoff, we're out of time, but one last question I try and ask of all our guests. Can you share with us anyone that you think has been a great influence on your work, or perhaps a favorite book or books that you think that you would recommend to other technicians to become acquainted with?
I think, I don't know if you've ever come across a guy called Bert Balan. He used to work for Swiss Bank Corporation in the old days.
How do you spell that?
Bert, B-E-R-T-B-A-L-N. Yeah, he worked with Jim O'Neill in the old days at Swiss
Goldman?
Bank.
Oh, excuse me.
At Swiss Bank in the old days. He wrote, I don't know if it's even in print, but he wrote an excellent book on Elliott wave analysis in the currency markets. I'd recommend that to anybody. You can get a copy of it. But the whole idea, setting out, in terms of, what drives the market, which was also covered in that. It wasn't a particularly long book, but I would say, I would cite that particular man as a seminal influence on my subsequent career.
All right. Well, Geoff, it's just been great having you with us today. We appreciate you sticking around late in the day in London to join us. Is there anything else you'd like to mention before we conclude?
No, I mean, I think the one thing I would say, there are probably, a lot of people out there thinking that maybe the fundamental analysis has not really delivered too much this year. I would advise certainly having a look at technical analysis, but above all, if you're going to get involved in it, you've sort of got to get involved in it yourself. You've got to look at the markets on a daily basis, get into the detail, and just keep going. I think there's to some extent, it's, like in most things, it's like in derivatives trading, a little knowledge is a dangerous thing. But I think if you stick at it and you do it yourself and you apply yourself, I think it will give you a very, very valid perspective on the market, which might give you something in addition, and which is complementary to your more fundamental macroeconomic views.
Oh, that's a very positive way to end it. And so today's guest has been Geoff Wilkinson, and that wraps up today's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer Shane Squark in New York City. Say goodbye, Shane.
So long, everybody.
Let's keep our stops tight. Good day.